traders, and welcome to a new video on auction market theory. So today's video, we're going to be looking at a different way of looking at the market. And this was the Patreon suggested. And one more thing before we go into the video is I will be releasing my price action volume guide very soon, probably within this week or the next. And more details will be coming out on that soon. Super excited to be releasing that soon. So I think that too many traders just jump into the market, attach themselves to a technical indicator too, or some trading guru, and then they just continue to do the same thing over and over and over again. And I think a lot of these traders don't really understand how the market works and how the market moves from one point to the next. They just call it random, and that's the end of it. And I think that kind of analysis can only get you so far. But what we're going to look at today is the auction market theory analysis. And this is looking at the market in a bit of a different way than it is typically looked at. And I think that this kind of method is very helpful for scalping and for day trading within a day's time. So when I say auction, a lot of people are probably going to be thinking of just an auction where we have one seller, a person who's offering an item to sell, and we have a series of buyers who are shouting up prices that they would like to buy that item at. So imagine one guy says, "Hey, I'll buy it at $10, here," and then we have another guy whose price goes up, and let's say some guy says, "Hey, I'll buy it at 11," and this is just going to continue happening. Price is just going to continue going up until no one else wants to buy, until the bidding stops and then price goes sideways. So in just a single auction, in just a normal auction, price can only go in two directions. It can go up or it can go sideways. Price can never go down because when price goes from 10 to 11, you can't bid at 10.5 in an everyday auction because the 11 is higher than 10.5. Your bid would be pointless. It would never transact, with you buying the item. So this is just what a single auction looks like. And the reason I'm bringing this up is all major markets, the NYSE, corn commodities, Bitcoin, a lot of these markets work in a double auction system, not a single auction, but in a double auction. And what a double auction is a system where not only do competitive buyers enter prices that they would like to buy at, but also competitive sellers are going to enter prices that they would like to sell at. Whenever a buyer and a seller both agree to one price, then that price will lead to a transaction. Now, what would a double auction market, be it gold, silver, corn, Bitcoin, S&P, or S&P futures, or really anything really that gets traded internationally or anywhere? It's not going to look like this. It's not going to look like just a single auction because there is not just one seller who gets to just, sell at a beautiful price, but it's going to look more like this. Most of these markets, most international markets over time are going to be consolidating, are going to be spending a lot of time just doing that. And when they do this, this is known as fair value. Within the auction market theory system, we have two states of balance. We have a state of balance and a state of imbalance. And when we have a state of imbalance, that is when price is beyond fair value, below a consolidation range, or above fair value, above a consolidation range. And the way in which we determine what is fair value, how do I even get this, is done through the market profile, or in our case, the volume profile. Now, one other thing to think about is, before we go into this deep dive into auction market theory and really how that works, is think of the last traded price. So the price that you read on a TradingView chart or a CryptoWatch chart or an exchange chart or really anywhere. Think of price as an advertisement of an auction to gauge the level of interest. So when price goes, let's say in this double auction system, which is how Bitcoin is traded through a double auction, price goes a little bit below. What's going to happen is this is beyond fair value. This is below fair value. And one of two things is going to happen. One, the buyers are going to immediately buy this back up because the coin is trading below fair value. Or 2, there's more excess supply, meaning more people want to sell, and then price is going to continue moving down. Now, how can we tell when there's more excess supply or excess demand? The best thing that we can do, and this is another video's topic, is you can look up, it's on my channel, I can just link in the description below, but MDR, looking at supply and demand. And then that will show you how to, hey, when do I know when is there excess supply on Bitcoin? When do I know is there excess demand on Bitcoin? But going back to here, we know that excess supply and excess demand is what creates trends. That is why price doesn't just consolidate all the time. It's because there comes a point in time where more people want to buy, and there comes a point in time where more people want to sell. And if more people want to sell, price isn't just going to range, it's going to begin a downtrend. Now, what we would call a market at balance, or a market that's consolidating in a range, is it has found fair value. And a market at imbalance, or a market that is trending up or trending down, is looking for fair value. So what that looks like is, imagine that this market here has consolidated for a few hours and is just really jumping to highs and lows, and people are trading, and price isn't really trending. Then price goes down to here because of excess supply. More people are looking to sell, more limit orders to sell than limit orders to buy. And then we get this. Price finds a new area of consolidation, or also known as a new area of balance, a new area of fair value. So this is the new area where price is finding fair value, and let's say that there's more excess supply, excess demand, and then price goes above the range high, and then it finds another area of fair value, and it would look like this. So this is what, if you look up auction market theory, this is what so the diagrams and a lot of them are going to look like, because this really explains how these double auction markets work. Now, we know that markets like to move toward balance. Markets like to move toward liquidity and fair value, allowing people to trade. What this means is that more often than not, if you were to look at a price chart of the S&P, of Bitcoin, of gold, of any of these, more often than not on these lower time frames, the price is going to be consolidating more than it will be trending. Of course, there are going to be times where some assets are trending more than they're consolidating, but overall, more assets than not, and especially crypto over these past few months, more likely to be consolidating and trading at fair value than to be in a very strong trend in the short-term timeframes. Now, when price is within this fair value, when price is trading within this here, that is known as trading at fair value. But when price is trading outside of this range, this range here, this is known as trading at trading away from value. So what can actually occur sometimes is not always these beautiful, it goes from one value area to the next, but something like this, a bit messier, where price goes a little bit below a value area, price goes a little bit below a range, and it goes a little bit of a range to advertise to the buyers to buy at a lower price. And once it advertises to the buyers to buy at a lower price, this imbalance that used to occur because price did go below the balanced range, actually price goes just higher. Now, when we are trading these markets, when auction market theory traders are trading in general, what we typically want to do is we want to trade inefficient markets. We want to trade away from value. We're looking to make our trades. And of course, this is not every auction market theory technician. Some are going to be doing this differently. It varies for everyone. But typically, you're going to want to make your trades if you're using auction market theory. And I'm going to show how to do that soon. When price goes just below a range low, or when price goes just above a range high. And it's at this point in time, when price is not trading at fair value, that we want to decide to buy or sell. And typically, we would want to buy when price goes below fair value, and typically we want to sell when price goes above fair value. Now, here's how we actually do that, and it's going to be done using the volume profile. You can do this in two ways. You can use TradingView, which requires a TradingView Pro plan, Or you can use tensorcharts.com, which I think has a cheaper plan than TradingView, and they also have the same kind of tools that TradingView has for their volume profiles. Now, the three most important terms to know here are value area high, value area low, and the point of control. Now, the value area high is the high of this market balance. It's this part here, that part there. The value area low is the low of this market balance here. Now, the good news is that we don't have to just imagine these. These are actually drawn, and they change over time. So what I have here is the top blue line is known as the value area high. The bottom blue line is known as the value area low. Between these two areas is known as the value area. Think about this as fair value for this market. Now, what we would expect is that whenever price trades a little bit be outside of fair value, that this offers us a really good opportunity to buy or sell. So look right here at a few times when price goes below the bottom blue line. Here would have offered some good times to buy, here as well, here, and here. And the reason this occurs is price is trading at fair value, fair value, fair value, fair value, fair value. Oh, and then it goes right, below fair value, and we want to take advantage of that inefficiency in the market. And then price goes right back up. Price goes above fair value, goes back into fair value. Price goes outside of fair value, then goes back into fair value, goes outside of fair value, then really, goes back lower here. And that is the pattern that tends to occur. As you can see here, price tried to go higher, failed, and then went right back into trading at a balanced range at fair value. Here, price tried to go lower, but then price just went right back up to the range here. So this is how we use the value area high and the value area low to look for spots where we can trade an inefficient market, where we can trade outside of fair value. We can trade an imbalanced market. Now, a bit of a typo here, but we expect buyers in the auction to be interested in buying below the value area low, which means that when price goes down to the value area low, or when price goes slightly below the value area low, these are spots where we think that a large amount of demand is about to pick up. When price goes above the value area high, then these are spots where you expect sellers to be interested in selling at the value area high or above the value area high. Now, where does the point of control, come into this at all? So these two blue lines, value area low, value area high, that black line that you see here, and I'm going to make that a little bit bigger by doing this, is the point of control of the volume profile. Now, you may have noticed, I didn't mention it yet, but we're not even looking at a volume profile here. I actually minimized the volume profile part of this chart. And the reason I'm doing that is just to give a simple bare bones look at auction market theory. It is completely your choice of how you want to use the volume profile using auction market theory. You can use the very simplest, which would be something I'm about to show. You can use this way. You can use a volume profile. You could just use these two. It's all your choice of how you want to receive the information. Now, what we see here in the rules for the developing point of control is the area between the area between the value area high and the value area low. This is fair value. This is where the asset tends to trade at. And we expect that if price goes above, the price is going to come back down unless there's excess demand. And if price goes below the value area low, we expect price to revert back up to the value area, the fair value area, unless there's excess supply, unless things are telling us it's very bearish and that price is going to find a new fair value area. The point of control, that black line that you see there, is the price at which the largest amount of volume was transacted, or the most traders made trades. And we expect that price is going to likely reverse when it touches or goes just beyond the point of control. So one thing that happened here, you can see point of control was here, price went up, reversed at the point of control there. And then you can see the point of control did change a little bit here. We had some consolidation. Price went down below the point of control, reversed the point of control and went back down. Price went up to the point of control, reversed the point of control and went back down there. And there's two properties that you want to know about the point of control and relating it back to auction market theory. One is that of course, reversals tend to occur when the point of control is touched. As you can see here, price went up to the point of control, then went back down. 2 is that the market likes to move toward the point of control. So when the market moves very, far away from the point of control, like something like this, it's moving beyond fair value, beyond the fair value that was offered within the consolidation of the previous price range. So we'd expect price to revert back and move toward the point of control here. So when price moves, way below here, we expect price to revert back to that point in time, that price where a lot of trades were previously made. Price goes a lot higher like this, we expect it to revert back down to the point of control. Now, how did I make this drawing? What I did was I used the fixed range volume profile. I drew from the beginning of the consolidation to the current point in time here. You can make this even simpler. If you don't want to use this, you can use the VPSV. You get this by going click indicators and click session volume. Now this is going to show us the volume profile recorded every 24 hours at midnight UTC. So I'm UTC -5, so this is going to change every time at 19 o'clock. It's the same thing except that it changes every 24 hours. But this can give us really accurate readings in the very short term. So some examples here are, we can see, we expect, as you can see, right here, this is fair value. Price is clearly trading at fair value here. Fair value, fair value. Price goes below fair value, as you can see here, and then goes right back up into this range of fair value. So some other examples here. I think we had just one happen where this was the fair value range. Price is consolidating here. Price goes below fair value here, and then reverted back upward. Again here, fair value is from here to here. Price goes below, and then comes back into fair value. So it's your choice. If you want to use the session volume profile to find these points of where's fair value, where's price trading outside of fair value in the auction market theory, you can use the session volume profile. If you want more detail, you can use the fixed range volume profile. And that's where you get a period of consolidation or a balanced market, and you draw it over the entire period of consolidation. And if you want to use tensorcharts.com, you can use that as well. And you can use a session volume profile or a fixed volume profile on Tensor Charts. That is a bit more advanced, and the easiest way by far is just session volume profile with no volume profile. So that's just this basically. A little bit more advanced would be showing the volume profile and then making some reads off the volume profile. But if you want to keep it very simple, and that's what I've been showing today, just the simplest method possible, that's where we just use these. Just the point of control and the two value areas, the value area low and the value area high. So the whole purpose of this is really to look at ranging markets in a different way. A lot of traders are going to look at these ranging markets and just find them boring or just find them the same, but they really aren't. Think of the market like an auction, because it really is. It is a double auction, and prices are going to move up or down, not randomly, but they are going to move up or down over time. But there are price areas where we expect price to revert back to. If a large amount of trading has occurred at a certain price area, then we would expect that price would likely want to return to that area and continue to trade at that area. That's just how the market really operates. So again, don't make the mistake of always thinking that when price goes below a value area low, the price is just going to go, right back above. It typically does, but it will not always happen. Some good examples here: price goes above a value area high and then reverts back to the value area. But there's markets like this, as you can see, where that just would not have worked. Price is basically at the value area low the entire time because it's a downtrend. And you need to always be looking at other indicators to be gauging if there's more excess supply, if there's more excess demand. Use MDR, use BAS, use some of those that I've mentioned before, and those should help out a lot. And if you can really gauge supply and demand from that, then this kind of system can give you the prices for you to transact at. If you're looking to buy, you don't want to always buy at fair value. You can buy below fair value. If you want to sell, You don't always have to sell at fair value. You can sell above fair value. So if I'm looking to, let's say I'm looking to sell here, I sell here. I sell around here. I short or sell around here when price is moving on high volatility upward. We're trading way above fair value, and my indicators are telling me that price is still bearish. Great time to sell will be there. Or let's say here, I'm looking to buy. Price quickly cuts down, moves beyond fair value, which was from 34.38 to 34.5, moves down to about 33.90. You buy there, and then price reverts right back to fair value, or even more short term. Some beautiful examples here. Price is trading at fair value, and the range got very tight. Price goes above fair value, reverts back in. Trades back into fair value, goes below fair value, trades right back into fair value. And this is just how the market is going to, operate over time. So this is what we're trying to look for. We're looking for not only excess demand and excess supply, like what I had talked about in the past few videos, but balanced markets and imbalanced markets, and how to trade at the best possible prices within a balanced market, which is buying at an inefficient price, buying at away from value, buying below the value area low, selling above the value area high, or selling at the value area high or buying at the value area low. Both can work as well. You can buy or sell at the level or just beyond the level, and both would validate the theory of auction market theory. So this is just the first video that I've made about auction market theory. I might do a second. I might not. It depends on the feedback I get and really if there's any more to go into it, which I'm pretty sure there's a ton more to go into advanced ways of looking at the market, like an auction. But for this video, this just about does it. I think if you get any takeaway from this, use the volume profile. It's great. You can use the session volume profile. You can use the fixed volume profile for these for these methods to try to find where is fair value, where is unfair value, where is the market trading at an elevated rate or a deflated rate, or where can I buy at the best price, where can I sell at the best price. And it's best to not use the volume profile per session, which is here. But the fixed range I find is actually the most helpful. Find the level of consolidation, which I drew from here to here. Or you can go as short term as you want with this. If I just find this period of consolidation from here to here, it's going to give me, after I double click this and then do this and make it a little bit simpler, it gives me the value area here, and it's telling me, prices beyond the value area, and this could be a spot where we could think about shorting or selling. Or even here, price went above the value area, good spot to sell, and mean reversion back into here. Price goes below the value area, goes right back, below the value area, right back, above, back. So, if you're looking to trade ranges, if you're looking to trade these kinds of mean reversion strategies, where you expect price to just continue to move and stay balanced and to stay at fair value, then this could be a strategy for you. All right, if you have any questions about auction market theory or volume profile or anything of that on the contents of this video, you can shoot me a message on Discord or on my Patreon. Happy trading.